Welcome back to Prosperity Foundry, where we forge the path to financial wisdom, one video at a time. Today we're diving into the world of bonds, often hailed as the safe investment option. So, grab your favorite beverage, sit back, and let's demystify bonds together. Now, when we talk about bonds, we're essentially talking about a loan. But unlike borrowing from a bank, here, you're the lender. Imagine this. Governments or corporations come to you, hat in hand, asking for a loan to fund their projects. In return, they promise to pay you back with interest. That's basically what a bond is, an IOU with benefits. Bonds are often considered a safe haven in the investment world, especially when compared to the roller coaster of the stock market. But why is that? Well, it all comes down to predictability. When you buy a bond, you know exactly what you're getting: a fixed interest rate paid at regular intervals, and the return of your principal when the bond matures. It's like having a financial GPS guiding you through the investment landscape. Let's start with the basics. Bonds come in various flavors. You have government bonds, corporate bonds, municipal bonds, and even savings bonds. Each type serves a different purpose and comes with its own set of risks and rewards. Government bonds, for instance, are considered the safest because they're backed by the full faith and credit of the issuing government. In the US, we call these treasuries. They're like the rock-solid foundation of a well-diversified portfolio. But safety doesn't mean zero risk. There's always interest rate risk. Picture this. You buy a bond with a 2% interest rate. A year later, the rates go up to 4%. Suddenly, your bond isn't as attractive because new bonds are paying more. This can cause the value of your bond to drop if you decide to sell it before maturity. So while bonds are stable, they're not completely immune to market forces. Now let's talk about the yield, essentially the return on your bond investment. The yield is influenced by factors like credit quality and the bond's maturity. Higher yields often come with higher risks. Corporate bonds, for example, usually offer higher yields than government bonds because they carry more risk. It's all about balancing risk and reward. For those of you with a creative spirit, think of bonds as the steady baseline in your financial orchestra. They provide rhythm and stability, allowing you to take bolder solos with other investments, like stocks or real estate. Responsible investors know that having a mix of both aggressive and conservative investments can cushion the blow during market downturns. So, how do you start investing in bonds? You can buy them directly through a broker, or you can invest in bond funds, which pool money from many investors to buy a diversified portfolio of bonds. Bond funds offer instant diversification and professional management, which can be appealing if you're just starting out. And here's a little nugget for those who love to learn. The bond market is actually much larger than the stock market. It's a vast, intricate network that plays a crucial role in the global economy, influencing everything from mortgage rates to the funding of public projects. In conclusion, bonds are a vital part of a well-rounded investment strategy. They offer stability, income, and a sense of security in uncertain times. But remember, no investment is completely without risk. It's important to do your homework, understand your risk tolerance, and consider how bonds fit into your overall financial goals. Thank you for joining me on this exploration of bonds. If you found this video valuable, don't forget to like, subscribe, and share it with your friends. Stay tuned for more insights on investing fundamentals in our next video. Until then, keep building that prosperity.